Hello there and welcome to this Astranti bite-sized video. In this video, what you see on screen right now is an extract from our F3 syllabus on the topic of capital structure theory. Now, capital structure theory is something which is generally done at the strategic level, very much high-level thought for a business, but it is also applicable the further down the syllabus you go at F2 and F1 level, and even across the syllabus in the E's and P's, because at the end of the day, you need to understand the mixture of debt and equity and how that can affect business decisions. So what we're going to do in this video is go through the theory of capital structure and how to apply it to a business scenario. And this is all important for your CIMA F3 exam in particular. So without further ado, let's now take a look at this topic.
Hi, welcome to this video on capital structure theories. My name is Nick Best. I'm CEO here at Astranti, and I've taken over in this video series from our previous presenter who's taken us up to here. Well, why? Well, because these are my kind of specialist videos. I've been teaching these subjects for 20 years. And so I kind of want to share with you the experience that I've learned over that time. And what I might also say is that these are some quite tough subjects. So up until now, there's been some reasonably difficult topics so far, but we start to get onto the really hard stuff. And so I've kind of taken it on at this point in order to sort of share with you some of the knowledge and experience that I've learned in teaching these subjects over the years that I have been doing it. So that's one of the reasons why I've taken it on. So in this video, capital structure theories, what are we covering here? Firstly, what is a capital structure? It is to do with debt and equity and how we balance those. So we'll come on to that in a moment. Next, the traditional theory of gearing. What is the optimum level of debt and equity to have? That's what that's all about, the optimum level. Where do we get the balance just right that will earn the profit, the business, more money? Finally, a theoretical approach to gearing and debt and equity and getting that balance right. Modigliani and Miller's theory of gearing. So when we look at this from a purely theoretical standpoint, not the real world, the traditional theory is the real world. If we look at it theoretically, what can we learn? And there are some interesting lessons and some interesting theory that's been done, and it is part of the exam. What we also kind of find is that as you release some of the assumptions and restrictions on the purely theoretical model, you gradually move closer and closer and closer to the traditional theory, the one that has been used in practice for many years. So it's interesting as a way to really understand and get to grips with capital structure and gearing and trying to decide what's the right level of debt that a business should have. Ultimately, that's what this is about. Level of debt, level of equity. So let's get into financing capital structure. So the financing decision is trying to decide where we raise our capital from. And there are two main choices, the debt or the equity. Should we borrow the money from a bank or a bond issue on the market? Or should we raise money from shareholders? That's equity. And how much should we have of those portions? That's what we're going to be looking at as we go through this video. Now, all of that as part of the financing decision is to satisfy financial objectives. And what we find is that each company's got different objectives. It might be that a company is in terrible strife, real difficulties, and they haven't got any cash. And if they don't get some cash quickly, they won't be able to pay their suppliers, they won't be able to pay their staff, and the business is going to go under. Their financial objective will be, how do we get cash in the short term? And what would that be? I suppose it would probably be debt in that instance, if we're honest, because it's often very hard and time consuming to raise equity, particularly for big businesses, many months to raise that kind of funding. So it'd be more likely to be debt, get some short-term debt in that instance. Or it might be our financial objective is long-term growth. So perhaps in that instance, equity might be better. Maybe it's investment over 10, 20 years. Well, that long-term equity, money that doesn't have to be repaid back in the long term, which is maybe that's better. So the first element of debt or equity is considering what is appropriate for the financial objectives. But to be fair, that's not the main focus for us on this video. Our focus is more going to be about capital structure. It's to do with the fact that debt introduces risk into a structure, but it also improves returns because of the tax benefits. And what is the proportion of debt and equity which actually minimizes the costs of finance, the cost of capital, as we call it, and maximizes the value of the business? So this is the capital structure decision. So yes, financial objectives are important, and we have to decide. That's one element of debt and equity. Okay. But the next is, what's the optimum structure? So that's what we're going to be looking at. Real life businesses are making these sorts of decisions all the time. In 2010, just after the financial crisis, retailers were in a difficult position. BHS, British Home Stores, as it was a long time known, a company which is no longer around, they used debt to try and finance themselves through difficult times. In the end, they had £1.3 billion of debt, and they just couldn't service that debt. And of course, this is where the risk comes from with debt, is you've got to pay the interest and you've got to pay the debt back at the end. They couldn't survive. New Look, another retailer going through difficult times at the same time, they realized the difficulty of paying interest payments and tried to secure more equity funding for the long term. Actually, they didn't get it. And I think this is another issue with raising debt or equity. They couldn't get it because the shareholders weren't confident either about the market conditions and didn't want to give it to them. But they had the intention of reducing their risk by raising equity finance. Actually, New Look are still around and have been successful. So probably not to do with their decisions, because in the end, they both ended up with their debt. New Look had £1 billion of debt as well. It was probably actually the business side of things that meant that one survived rather than the other. But at least New Look were trying to do the right thing at the right time, although they couldn't do that. So let's take a look at this idea of capital structure then. What is capital structure? Well, as we've already said, we are combining equity, the ordinary shares, the shares owned by the owners of the business, and the debt, and bonds and bank loans. Now, in actual fact, you have another form of equity and debt hybrid securities, those that are in the middle, such as preference shares. And hopefully you remember that preference shares are shares in the business, but you're not the owner of the business. You don't have voting rights in the business with those. You get a set percentage return on them year in, year out, except you're not guaranteed payment. They are preference because you get those returns before the dividend that is paid for ordinary shareholders. So yes, they're preference, so they're less risky because of that. But to be honest with you, throughout the rest of this video and the whole theory of capital structure, we kind of ignore the hybrid securities. Well, we do ignore them, to be honest with you. And we're going to focus on debt and equity. The reason is to keep the theory clear and simple. Of course, in the real world, you would have to take account of these almost halfway houses. Preference shares are a halfway house between ordinary shares because you do get dividends, but they're not guaranteed. So it's not like debt where the interest has to be paid year in, year out, or month in, month out. Okay, so our main focus is going to be equity and debt in this particular case. And we think of it as a little bit like a structure, like a building, as we can see there. The structure of the building, what's the financing structure? And that financing structure is your proportion of debt to equity. And we call that the gearing. In this particular case, $80 million of debt out of a total funding of 100. If we add those two together, gives us a gearing of 80%. So it's that element of gearing, and you would have heard of gearing before and come across that in previous studies. It's the level of gearing that we are looking at. That effectively is what we mean by a capital structure.
Well, I hope you enjoyed this video, and if you want to see more like this, including mocks, revision notes, and even question tutorials, you can head on over to the Astranti website, where we offer a full course that gives you access to this wide variety of materials, all in order for you to help pass your exam. And if you'd like to stay in contact with us and see more posts like this, you can also subscribe to our social media channels, including Instagram, YouTube, Facebook, and Twitter.